Hi, I'm back, and I'm talking about the 4 adjusting entries that we need to learn to make the accrual basis of accounting go from cash to accrual. So what we need to do is talk about those 4, and I've given you pieces of paper that say there are 4 major groups. What are they? Prepayments, prepaid expenses, and prepaid revenues, and accrued revenues and accrued expenses. So I've got a lot of tips to tell you, but let's do a couple of illustrations on my easel that keeps moving around on this rainy Saturday morning. So the first one I want to talk to you about is prepayments or deferrals. You might see that word a lot of times in other books. And that is always when the cash happens before the action. Now, what does that mean? I say that a lot in class. That means some cash exchanged hands. Either I got some cash to do some work, or I paid out some cash for somebody to do something. But then the work wasn't done yet. So that's the action that I'm talking about. And remember what we talked about in the last video and we've talked about in class. Revenue is recognized when it is earned. That means when you have done the work. That is when you get to take the revenue. And expenses are recognized when they are incurred or when they match the period that they help make the revenue. And that's that matching principle we talked about. So let's talk about first prepaid revenues. Now this is the case, we've talked about this before, when cash comes in, but we haven't done the work. Let's just say we were talking about my having a consulting service, which is great. I love that. So I received cash for 4 months for a service that I'm going to provide to you. I'm going to help you figure out something in your business or do your taxes or something, but I'm going to do it on a regular basis. So you give me cash, or a customer of mine, a client gives me cash, and I can't take that as revenue yet because why? Why can I not say cash and service revenue? Right, because I did not do the work. So I have to put it somewhere. And that's what always happens when a check comes in. You have to record it. So you can't record it into service revenue. So we're going to record it into another account called unearned revenue. That makes sense. It's not earned revenue, it's unearned revenue. And this is a case of a prepaid revenue. So we'll credit the liability, and that's what that is because I owe the customer the work or the client the work, and I debit cash. So that was an entry we talked about when we were just talking about plain entries that come in, not adjusting entries. And we had some examples before. Now what happens after I've actually gone through 1 month and done some work for you? I have to think about that. So if I had $1,000 and it was for 4 months work and I'm going to regularly do the work, like we assume that's going to happen, then I'm going to divide 1,000 by 4, and that's $250. And I'm going to go ahead and take $250 out of this liability account, because at the end of that month, what would this be? $750 that I would still owe you the work. But now on my books, I don't owe anybody anything after January 31st but $750. So what do I do with that $250? I'm debiting the unearned revenue account because that's how I take it out. Remember, debits make liabilities go down. And I'm going to credit what I call real revenue, but don't ever write that, but service revenue, because I actually did some work for you this month. And that's on January 31st. Now, if you notice in the book, a lot of companies don't close their books but on the December 31st. So if there's been a period of time where we've gone through several months, then you're going to have to calculate it for that period of number of months. And I'll come back and do another problem from the book on a video and show you how maybe you have to multiply by a certain number of months. The following month, February 28th, will be my closing because it's a leap year, not a leap year. And I have 1 more month. So I have another $250 that's going to come out of this liability and I have earned another month. And I would continue to do that until what? Till my liability is equal to 0 and I have earned all $1,000. Now, if there's a period of time in that time that I didn't earn any, then I would not do the adjusting entry. But let's just assume that that's what happens on a regular basis. Does that make sense? That's from the person who has received the cash and who is actually earning the revenue. That's a prepaid revenue. Now let's talk about the other side of that. Now prepayments for expenses, we've talked, have several cases. And the other side of this, if this is your books on prepaid and you have prepaid consulting fees to SK Consulting, then you would have like debited prepaid consulting fees, because what kind of account is that if you have paid something ahead of time but you haven't used it? Okay, remember how we call those things that we own assets? And they're a future economic benefit to us, or they're a resource. So that resource right there is something you own and you have paid the cash for it. Now, have you had any expense up to that point? No, because no work has been done. Remember, in prepaids, the cash precedes or comes before the action. So you gave me a great check. Thank you so much. But I haven't done anything for you yet. So you don't take any expense. What happens at the end of January when I have been helping you start your business or whatever? Then you get to take some consulting expense or have to take some expense, and then you relieve this prepaid consulting fee account by $250. So taking that prepaid consulting fee account, I don't know if you can see this, it's not very dark, $1,000 down $250, so that now what is your asset worth? $750, because that's all that you have left in that asset. And what does that represent, that $750? At January 31st, that represents that you have 3 months left that you have prepaid for me to do some work for you. So if I continue to do the work every month and don't skip a month, then each month we will credit that prepaid consulting fee expense. And again, you don't have to have this word expense here, but that's what the technical word for it is. The critical word is prepaid. So every month I'm going to credit prepaid consulting fee and debit consulting fee expense. Does that make sense? Or consulting expense? So at the end of those 4 months, there is no asset on your book. And unless you prepay me again, there won't be. But you have expensed 4 months of consulting. Hopefully that makes sense. Now try to practice a couple of these and see if you can do them. This category also, I want to make a note of this, includes supplies and depreciation. Can you do those entries? We talked about how we do supply entries. Supplies are done by buying them, and then taking a sort of an inventory, not the inventory we talk about later in the book, but an inventory to see what was used, and then that we back into that. So we can do some entries like that too. Depreciation is sort of different because it's got that accumulated depreciation contra asset account in it. So we can come back and do those too. But these are the basic entries for a prepaid expense. And I've told you on that little sheet of paper that the generic entry for a prepaid expense to get it recognized is to debit an expense and credit an asset. And in every one of these cases, prepaid insurance, prepaid fees, supplies, and depreciation, we are debiting expense and crediting an asset. Go practice that, and we'll get on to accruals.